This is a gallon of gasoline. At the station down the street, it costs $3.47. You pay in dollars. The station pays its supplier in dollars. The supplier pays the refinery in dollars. The refinery pays the oil producer in dollars. Every transaction, from the wellhead in the Saudi desert to the pump in your neighborhood, is denominated in the same currency. This is not an accident. This is architecture. For 50 years, every barrel of oil sold by OPEC has been priced in US dollars. Not because dollars are superior, not because it's more efficient. Because in 1974, Henry Kissinger flew to Riyadh and made a deal that shaped the modern world. America would guarantee Saudi Arabia's security. Saudi Arabia would guarantee that oil trades in dollars. That deal ended on Tuesday. At 11 p.m. Riyadh time, January 21st, 2026, the Saudi Arabian Monetary Authority published a 3-sentence statement that unwinds half a century of monetary architecture. Effective March 1st, the Saudi riyal will no longer be pegged to the US dollar at 3.75. The new peg will be a basket of currencies weighted by trade volume. Oil contracts with non-dollar nations may be settled in local currencies. 3 sentences. 50 years of dollar dominance. Over. The Brent crude price dropped $12 in 4 hours. Not because oil became less valuable, because the market suddenly couldn't answer a question it had never needed to ask. If oil isn't priced in dollars, what is a dollar actually worth? This is not about Saudi Arabia seeking a better exchange rate. This is about the end of the system that made the dollar the world's reserve currency. Here's what they're not telling you. The petrodollar system was never about oil. It was about demand. Structural, permanent, artificial demand for US dollars that would exist regardless of American economic performance. Think about what it means that every country on Earth needs dollars to buy oil. Japan has no oil. They need to import every barrel. To import oil, they need dollars. To get dollars, they must either sell goods to America or buy dollars in foreign exchange markets. Every oil-importing nation faces the same constraint. Dollars aren't optional. They're mandatory. This created a one-way flow that has subsidized American living standards for 2 generations. The U.S. could run trade deficits indefinitely because the world needed dollars regardless of what America produced. The U.S. could print trillions without inflation because global demand absorbed the supply. The U.S. could fund wars, tax cuts, and stimulus programs by issuing debt that foreign nations had to buy, because where else would they hold the dollars they needed for oil? Every privilege America has enjoyed since 1974, the ability to borrow cheaply, to consume beyond production, to project military power on credit, traces back to a handshake in Riyadh that made the dollar irreplaceable. Saudi Arabia just made it replaceable. The official story is that this is a technical adjustment, that the new currency basket better reflects Saudi trade patterns, that oil markets are mature enough to handle multi-currency pricing. The Saudi finance minister gave a statement at 7 a.m. Wednesday calling it modernization, not de-dollarization. The data tells a different story. In the past 18 months, Saudi Arabia has signed yuan-denominated oil contracts with China, totaling 1.2 million barrels per day. They've opened Riyal-Rupee direct settlement with India for 400,000 barrels daily. They've negotiated ruble-Riyal swaps with Russia that bypass dollar clearing entirely. Tuesday's announcement didn't create a new system. It legitimized one that's been building in the shadows for years. This is where the lie becomes unsustainable. To understand what breaking the peg means, you need to understand how currency pegs work and why countries maintain them. Saudi Arabia has kept the riyal at 3.75 to the dollar since 1986. To maintain this peg, the Saudi central bank must intervene constantly. If the riyal strengthens beyond 3.75, they print riyals and buy dollars. If the riyal weakens, they sell dollars and buy riyals. The peg is not automatic. It requires massive dollar reserves and continuous market operations. At its peak in 2014, Saudi Arabia held $737 billion in foreign reserves, almost entirely in dollars. This war chest allowed them to defend the peg through oil price crashes, regional conflicts, and global financial crises. The dollars were insurance, ammunition, proof of commitment. Today, Saudi reserves stand at $418 billion, still substantial, but $319 billion lower than the peak, and falling every month as they fund Vision 2030 megaprojects, maintain social spending, and defend a currency that's becoming harder to defend. The math eventually breaks every peg. If oil revenues decline while spending increases, reserves drain. If reserves drain far enough, defending the peg becomes impossible. Saudi Arabia saw this future. They could either wait until a crisis forced them off the peg as happened to Argentina, Thailand, and Russia, or they could exit on their own terms while reserves remained strong. They chose the exit. The timing is not coincidental. They announced it after securing alternative payment arrangements with their three largest customers, China, India, and the EU. They announced it after the Federal Reserve signaled that U.S. interest rates would remain elevated, making dollar strength painful for PEG countries. They announced it after calculating that the cost of maintaining the fiction had exceeded the cost of ending it. When nations do what Saudi Arabia did on Tuesday, they're not adjusting policy. They're abandoning allegiance. The response from Washington reveals the stakes. Within 6 hours of the announcement, Treasury Secretary Janet Yellen was on a plane to Riyadh. No public statement, no press availability. An emergency trip that appeared on no official calendar. At 3:15 a.m. Eastern, the Federal Reserve issued a statement that it was monitoring developments in global currency markets. Fed speak for, "We have no idea what to do, but we need to say something." The White House released a 40-word statement calling the Saudi move a sovereign decision that we respect, while remaining committed to the strength and stability of the U.S. dollar. Respect, commitment, diplomatic language that barely conceals panic. The last time a major oil producer attempted to break from dollar pricing was Iraq in 2000. Saddam Hussein announced that Iraqi oil would be sold in euros. 3 years later, Iraq was invaded. The first act of the new government was returning oil sales to dollars. Libya's Gaddafi proposed a gold-backed African dinar for oil trade in 2011. NATO intervened within months. After his death, Libyan oil returned to dollar settlement. Saudi Arabia is not Iraq or Libya. They have $418 billion in reserves, the world's second-largest oil production, and security relationships with every major power, including China. They cannot be invaded. They cannot be sanctioned without triggering a global energy crisis. They have leverage that no previous dollar defector possessed. The implied threat in their Tuesday announcement isn't military, it's financial. If America retaliates economically, Saudi Arabia holds $120 billion in U.S. Treasury securities. They could sell them in a week. They could refuse to roll over maturing positions. They could demonstrate to every other Treasury holder what happens when dollar dependency becomes dollar hostility. Less than 38 days remain before the new currency regime takes effect on March 1st. Between now and then, every oil contract written, every tanker booked, every refinery purchase order must answer a question that hasn't been asked since 1974. What currency? The market is not ready for this question. Commodities trading infrastructure, the exchanges, the clearinghouses, the pricing benchmarks, was built assuming dollar denomination. Brent is priced in dollars. WTI is priced in dollars. Every derivative, every swap, every futures contract assumes dollar settlement. Unwinding that assumption in 38 days is not difficult. It's impossible. What happens instead is fragmentation. Dollar oil trades on one set of prices. Yuan oil trades on another. Rupee oil on a third. The single global benchmark that allowed efficient price discovery becomes multiple regional benchmarks with arbitrage gaps, liquidity mismatches, and counterparty confusion. This is why Brent dropped $12 in 4 hours. Not because oil supply changed, because price discovery broke. While one side scrambles, the other side prepared. This is the asymmetry that makes the petrodollar collapse different from previous currency crises. Saudi Arabia didn't announce on Tuesday and start building alternatives on Wednesday. They've been building for 5 years. The Saudi-Chinese relationship tells the story. In 2022, Xi Jinping visited Riyadh, the first Chinese state visit in 6 years. The public agenda was investment and infrastructure. The private agenda was payment systems. Within months, the first yuan-settled oil cargoes left Saudi ports for Chinese refineries. In 2023, Saudi Arabia joined the BRICS Development Bank and began negotiations for full BRICS membership. In 2024, they joined the mBridge project, a central bank digital currency platform connecting China, UAE, Thailand, and Hong Kong for cross-border settlement without SWIFT or dollar clearing. Each step was reported in isolation. A trade deal here, a bank membership there, a pilot program somewhere else. Tuesday's announcement connected the dots. The infrastructure for post-dollar oil trade doesn't need to be built. It exists. It's been tested. It's operational. China settles 30% of its Saudi oil imports in yuan today. By March 1st, that number will be 100% for participating refineries. India is converting 40% of Saudi imports to rupee settlement. The EU is negotiating euro-denominated contracts for 2026 delivery. The dollar share of global oil trade, 90% for 50 years, could fall below 60% by summer. This is what a system looks like when the foundation cracks. Every response available to the United States now carries costs that weren't conceivable 5 years ago. Sanction Saudi Arabia, and oil prices double overnight as 12 million barrels per day of production becomes legally untradeable for Western refiners. Threaten military action, and China's security guarantees to the Gulf activate a confrontation America cannot win. Raise interest rates to strengthen the dollar, and you crash the domestic economy while accelerating de-dollarization by making dollar debt more expensive for everyone. Print more dollars, and you confirm exactly what the Saudis are claiming, that the dollar is a depreciating asset being inflated away by a government that cannot control its spending. Do nothing, and watch country after country follow Saudi Arabia's example, each defection making the next one easier. The petrodollar didn't just give America cheap financing, it gave America power. The ability to exclude nations from the global economy through sanctions. The ability to track every transaction through SWIFT and dollar clearing. The ability to freeze assets, seize reserves, and weaponize finance against adversaries. Russia discovered this power in 2022 when $300 billion in central bank reserves were frozen overnight. Iran has lived under it for decades. Venezuela, North Korea, Syria, the list of nations excluded from the dollar system grows every year. Each exclusion was meant to demonstrate American strength. Instead, it demonstrated American willingness to weaponize the currency. And nations that might be next on the list took notes. Saudi Arabia took notes. They watched Russia's reserves vanish with a keystroke. They calculated their own exposure. They asked, if the relationship with Washington sours, could our $418 billion disappear too? Tuesday's announcement is the answer. Not openly hostile, not confrontational, just a quiet repositioning away from a currency that has become a weapon in the hands of the nation that issues it. Some will see Tuesday's news as a technical adjustment, an economic decision by a sovereign nation optimizing its currency regime. Oil will still flow, markets will adapt, the dollar will remain important even if it's no longer dominant. These are the same voices that said the euro would never challenge the dollar, that said China would never internationalize the yuan, that said sanctions would never backfire, that said the petrodollar was permanent because the alternative was unthinkable. The unthinkable happened on Tuesday at 11 p.m. Riyadh time. Others will recognize what the announcement represents. Not a policy change, but a paradigm shift. The end of automatic global demand for dollars. The beginning of a fragmented energy market where currency is a competitive variable. The moment when 50 years of American privilege started its countdown clock. The informed are not panicking. Panic is for those who didn't see the signposts. The yuan contracts, the BRICS expansion, the Enbridge pilot, the declining reserves, the growing rift between Riyadh and Washington over everything from oil production to regional security to the war in Ukraine. What the informed understand is that Tuesday wasn't a beginning, it was an ending made public. The architecture has been shifting for years. The announcement simply acknowledged a reality that markets are now forced to price. This is not financial advice. This is not a recommendation to sell dollars or buy oil or short treasuries. This is simply an observation that the system which made the dollar irreplaceable has been replaced. That 38 days from now, when March 1st arrives, the world will discover what oil prices look like when the currency of denomination is negotiable. The petrodollar was a deal, security for denomination, protection for pricing. It worked because both sides benefited and neither side had alternatives. America had the military, Saudi Arabia had the oil. The marriage was stable because divorce was unthinkable. Divorce is no longer unthinkable. The papers were filed on Tuesday. The dollar's value was never just economic, it was architectural. Built on a foundation of mandatory demand that every oil-importing nation had to satisfy. That foundation cracked on January 21, 2026, at 11 p.m. Riyadh time. What fills the void, yuan, euros, gold, digital currencies, or chaos, is the question that markets will spend the next decade answering. But the old answer, the one that defined global finance for 50 years, ended with 3 sentences on a Tuesday night. And it's not coming back.